Do you still believe buying altcoins in 2026 is the smart play? Because if you do, you're not early, you're not ahead, you're not even late. You're playing the wrong game. And I don't mean that in a dramatic clickbait way. I mean that in this is the exact mistake most retail investors make right before they lose another cycle kind of way. Let me explain. Right now, there are people loading up on altcoins like it's 2021 again. They're chasing narratives, they're chasing pumps, they're chasing the dream of turning $1,000 into $1 million. And I get it. You've seen it happen before. You've watched random tokens explode, you've seen screenshots, you've heard the stories. But here's the uncomfortable truth. Most people who won last cycle, they didn't win because they were smart. They won because they were early and lucky. And the game in 2026 is not about being early, it's about being right. And if you're still buying altcoins the same way you did in 2021, you're not adapting, you're not evolving, you're repeating the same mistake, just with different token names. So today, I'm going to break down exactly why buying altcoins in 2026 is the wrong strategy for most people, what the smart money is actually doing instead, and how to position yourself for real wealth, not lottery ticket outcomes. No hype, no fluff, no shilling. Just reality. Let's start with the truth no one wants to say out loud. Altcoins are no longer early-stage bets. They are late-stage experiments. And that changes everything. Let's break this down. Number 1, the altcoin game has fundamentally changed. Here's the first thing you need to understand. The altcoin market in 2017 was not the same as the altcoin market in 2021, and the altcoin market in 2021 is not the same as the altcoin market in 2026. Back then, there were maybe a few thousand crypto projects. Today, there are literally millions of tokens. Millions. Most of them have no users, no revenue, no real product, no long-term value, but they still pump. Why? Because liquidity flows where attention goes, not where fundamentals live. And that's the problem. In 2017, buying altcoins felt like investing in the internet. In 2021, buying altcoins felt like investing in startups. In 2026, buying altcoins feels like buying scratch tickets. Not because crypto is dead, not because blockchain is dead, not because innovation is dead, but because the signal-to-noise ratio is destroyed. There is too much noise, too much marketing, too many tokens, too many next big things. And most people can't tell the difference between real innovation and financial theater. So what happens? Retail piles into narratives. They chase hype. They rotate from token to token. They feel productive. They feel active. They feel smart. But their portfolio doesn't grow. It just rotates. They're not compounding wealth. They're just transferring money between bags. And here's the brutal truth. If your strategy relies on catching the next big altcoin, you're no longer investing. You are speculating on attention cycles. That worked when the market was small. It doesn't work when the market is saturated. And that brings us to the next problem. Number 2, most altcoins are designed to extract, not create value. This one hurts, but it's true. The majority of altcoins are not designed to create long-term value. They're designed to extract short-term liquidity. Let that sink in. Tokenomics today are engineered around vesting schedules, unlock cliffs, insider allocations, VC exit strategies, not long-term user adoption, not sustainable revenue, not defensible network effects. Most altcoins follow the same script. Step 1, create a compelling narrative. Step 2, raise money from private investors at ultra-low valuations. Step 3, launch the token to the public at a much higher valuation. Step 4, use marketing to drive attention. Step 5, use that attention as exit liquidity. And then what happens? Retail becomes the exit, not the partner, not the beneficiary, not the long-term holder, the exit. And you can see this clearly if you actually look at the data. How many altcoins from 2017 are still relevant today? How many from 2021 are even talked about now? Very few. Most are down 90%, 95%, 99%. Not because crypto failed, but because those tokens were never meant to succeed long term. They were meant to launch, pump, distribute, and fade. And here's where most people get confused. They think, well, I just need to find the good ones. But the problem isn't just finding good projects. The problem is that even good projects don't always translate into good investments. Why? Because token design matters more than technology. Because supply matters more than vision. Because incentives matter than white papers. And most retail investors don't analyze token supply curves, emission schedules, or insider unlocks. They look at price charts. They look at narratives. They look at Twitter sentiment, which is exactly what insiders want. So if you're still buying altcoins because you believe in the tech, I respect that. But belief doesn't equal profit, and conviction doesn't protect you from dilution. Which brings us to the next uncomfortable reality. Number 3, Bitcoin and Ethereum are no longer just crypto, they are strategic assets. Here's the mental shift most people haven't made yet. Bitcoin is no longer just crypto. Ethereum is no longer just a smart contract platform. They are now financial infrastructure. Bitcoin is a monetary asset. Ethereum is a settlement layer. They're not competing with altcoins. They're competing with gold, bonds, treasuries, real estate, global payment rails. And that's a completely different game. When institutions allocate to Bitcoin, they're not thinking, how do I 100 this? They're thinking, how do I preserve value in a broken monetary system? When institutions allocate to Ethereum, they're thinking, how do I gain exposure to programmable money and decentralized infrastructure? This is the part retail hasn't internalized yet. Bitcoin and Ethereum are not growth stocks. They are base layer assets. They are digital commodities. They are the foundation of the crypto economy. Altcoins sit on top of them. They don't replace them. And here's the key difference. When you buy Bitcoin or Ethereum, you're betting on the growth of the entire crypto ecosystem. When you buy altcoins, you're betting on one narrow outcome within that ecosystem. That's a much harder bet. It's like choosing one startup instead of owning the index. Except the index here is still volatile, but at least it's structurally aligned with long-term adoption. And here's the irony. People avoid Bitcoin because it feels too big. They avoid Ethereum because it feels too mature. But that's exactly what makes them powerful. They're no longer experimental. They're no longer niche. They're becoming innovatable. And wealth isn't built by chasing what's small. It's built by owning what's foundational. Which leads us to the next truth. Number 4, most people confuse activity with progress. This is one of the biggest psychological traps in crypto. Trading feels productive. Buying altcoins feels like you're doing something. Rotating portfolios feels like you're optimizing. Watching charts feels like you're engaged. But none of that guarantees progress. In fact, most of the time, it guarantees underperformance. Why? Because markets reward patience, not motion. And crypto, ironically, punishes overactivity more than almost any other market. Think about it. The people who did best in Bitcoin weren't day traders. They weren't flipping narratives. They weren't chasing pumps. They were boring. They bought, they held, they ignored noise, and they let time do the work. Meanwhile, the average altcoin trader buys at excitement, sells at fear, rotates at the worst possible time, repeats the cycle, not because they're dumb, but because they're human. And crypto markets are engineered to exploit human psychology. They move fast, they move violently, they move emotionally, which makes long-term decision-making incredibly difficult. So what do most people do? They try to outsmart the market. They think, I'll just trade better. I'll just time entries better. I'll just rotate into the next narrative earlier. But timing the market consistently is not a skill. It's a statistical anomaly. And the longer you try to beat randomness, the more randomness beats you. Here's the reality. If your strategy relies on constant monitoring, constant adjusting, constant reacting, it's probably not a good strategy. Good strategies reduce the need for action, not increase it. And this is where most altcoin strategies fail. They require too much precision, too much timing, too much emotional control, which humans are bad at, especially under volatility. And now let's talk about something most people don't want to hear. Number 5, the biggest risk in 2026 is not missing out. It's misallocating capital. Everyone talks about FOMO. No one talks about misallocation. But misallocation is far more dangerous because FOMO costs you potential upside. Misallocation costs you time, and time is the only thing you can't get back. Here's what most people don't realize. You don't just lose money when an altcoin goes down 90%. You lose years. Years that could have been compounding in better assets. Years that could have been building real wealth. Years that could have been reducing financial stress. Instead, they're spent recovering, trying to get back to break even, chasing losses, making riskier bets. And this is how people get trapped in cycles, not market cycles, emotional cycles. Hope, excitement, greed, fear, despair, hope again, over and over, while their net worth goes sideways or down. And here's the worst part. Most people don't even realize they're stuck because they're still in crypto. They're still investing. They're still learning. But learning without improving results isn't learning. It's just repetition. So let me ask you a direct question. If you've been in crypto for years and your portfolio isn't meaningfully larger than when you started, is the market the problem or is the strategy the problem? That's uncomfortable, but necessary. Because 2026 is not the time to repeat old mistakes with new tokens. It's the time to rethink the entire approach. And that brings us to the real shift you need to make. 6. The real game in 2026 is positioning, not speculation. This is where most people misunderstand what smart money actually does. Smart money doesn't chase pumps. It positions early in infrastructure. It accumulates when things are boring. It holds when things are quiet. It exits when things are euphoric. And most importantly, it doesn't try to outsmart the market. It aligns with it. Smart money looks at macro trends, monetary policy, regulatory shifts, institutional adoption, technological infrastructure, and then positions accordingly. Right now, the macro narrative isn't which altcoin will 100x, it's digital assets are becoming part of the global financial system. That means Bitcoin as a monetary asset, Ethereum as a settlement layer, stablecoins as payment rails, tokenized assets as financial primitives. That's the real story. And here's the key insight. Most wealth in crypto will not come from catching the next meme coin. It will come from being positioned in the assets that benefit from systemic adoption, not hype cycles, not attention spikes, not influencer narratives. Systemic adoption. That's slower. That's less exciting. But that's how real wealth is built. Not overnight, but over time. And here's the part that confuses people. They think, well, if it's slower, then it's not worth it. But slow growth compounds. Fast growth crashes. And you can't compound something that keeps going to zero. Now, does this mean altcoins are completely useless? No, it means their role in your portfolio should be radically different, not as the core, not as the foundation, but as optional exposure, as asymmetric bets, not primary strategy, which leads us to the most important shift of all. 7. You don't need more risk, you need better risk. Most people think the problem is they're not taking enough risk, so they buy smaller tokens, lower market caps, more speculative projects. But the problem isn't risk, it's bad risk. There's a difference between calculated risk and blind risk, strategic risk and emotional risk, asymmetric risk and random risk. Good risk has a clear thesis, a defined downside, a realistic upside, a logical reason for appreciation. Bad risk has hype, hope, emotion, stories. Most altcoin bets are bad risk, not because they can't go up, but because the probability-weighted outcome is negative, meaning yes, some will explode, but most will underperform, and a few will go to zero. And unless you're extremely skilled at timing, which most people aren't, you're likely to underperform even if you pick a winner, because you'll enter too late, exit too early, or ride it all the way back down. So instead of asking, how do I find the next 100x, the better question is, how do I structure my portfolio so I win even if I'm wrong? That's what smart investors do. They don't try to predict the future perfectly. They build portfolios that benefit from multiple outcomes. And that's the game in 2026. Not prediction, positioning. Which brings us to the framework you actually need. 8. The 2026 crypto framework, the one no one talks about. Let's simplify this. If you want to build wealth in crypto in 2026, you need 3 layers. Layer 1, foundation assets. Layer 2, growth assets. Layer 3, speculative assets. Most people skip Layer 1 and go straight to Layer 3. That's the mistake. Layer 1, foundation assets. This is your base. These are assets you believe will exist, function, and grow over the next decade. Money when an altcoin goes down 90%, you lose years. Years that could have been compounding in better assets. Years that could have been building real wealth. Years that could have been reducing financial stress. Instead, they're spent recovering, trying to get back to break even, chasing losses, making riskier bets. And this is how people get trapped in cycles, not market cycles, emotional cycles. Hope, excitement, greed, fear, despair, hope again, over and over, while their net worth goes sideways or down. And here's the worst part. Most people don't even realize they're stuck because they're still in crypto. They're still investing. They're still learning. But learning without improving results isn't learning. It's just repetition. So let me ask you a direct question. If you've been in crypto for years and your portfolio isn't meaningfully larger than when you started, is the market the problem or is the strategy the problem? That's uncomfortable, but necessary, because 2026 is not the time to repeat old mistakes with new tokens. It's the time to rethink the entire approach. And that brings us to the real shift you need to make. 6. The real game in 2026 is positioning, not speculation. This is where most people misunderstand what smart money actually does. Smart money doesn't chase pumps. It positions early in infrastructure. It accumulates when things are boring. It holds when things are quiet. It exits when things are euphoric. And most importantly, it doesn't try to outsmart the market. It aligns with it. Smart money looks at macro trends, monetary policy, regulatory shifts, institutional adoption, technological infrastructure, and then positions accordingly. Right now, the macro narrative isn't which altcoin will 100x, it's digital assets are becoming part of the global financial system. That means Bitcoin as a monetary asset, Ethereum as a settlement layer, stablecoins as payment rails, tokenized assets as financial primitives. That's the real story. And here's the key insight. Most wealth in crypto will not come from catching the next meme coin. It will come from being positioned in the assets that benefit from systemic adoption, not hype cycles, not attention spikes, not influencer narratives. Systemic adoption. That's slower. That's less exciting. But that's how real wealth is built. Not overnight, but over time. And here's the part that confuses people. They think, well, if it's slower, then it's not worth it. But slow growth compounds. Fast growth crashes. And you can't compound something that keeps going to zero. Now, does this mean altcoins are completely useless? No, it means their role in your portfolio should be radically different, not as the core, not as the foundation, but as optional exposure, as asymmetric bets, not primary strategy, which leads us to the most important shift of all. 7. You don't need more risk, you need better risk. Most people think the problem is they're not taking enough risk, so they buy smaller tokens, lower market caps, more speculative projects. But the problem isn't risk, it's bad risk. There's a difference between calculated risk and blind risk, strategic risk and emotional risk, asymmetric risk and random risk. Good risk has a clear thesis, a defined downside, a realistic upside, a logical reason for appreciation. Bad risk has hype, hope, emotion, stories. Most altcoin bets are bad risk, not because they can't go up, but because the probability-weighted outcome is negative, meaning yes, some will explode, but most will underperform, and a few will go to zero. And unless you're extremely skilled at timing, which most people aren't, you're likely to underperform even if you pick a winner, because you'll enter too late, exit too early, or ride it all the way back down. So instead of asking, how do I find the next 100x, the better question is, how do I structure my portfolio so I win even if I'm wrong? That's what smart investors do. They don't try to predict the future perfectly. They build portfolios that benefit from multiple outcomes. And that's the game in 2026. Not prediction, positioning. Which brings us to the framework you actually need. 8. The 2026 crypto framework, the one no one talks about. Let's simplify this. If you want to build wealth in crypto in 2026, you need 3 layers. Layer 1, foundation assets. Layer 2, growth assets. Layer 3, speculative assets. Most people skip Layer 1 and go straight to Layer 3. That's the mistake. Layer 1, foundation assets. This is your base. These are assets you believe will exist, function, and grow over the next decade. Bitcoin, Ethereum, possibly a small allocation to other base layer infrastructure, but only if you deeply understand it. This Layer 1 is about preservation, participation, compounding. Not excitement, not adrenaline, not dopamine. Stability in an unstable market. This is the layer that anchors your portfolio. Without it, everything else becomes gambling. Layer 2, growth assets. This layer includes infrastructure projects, platforms with real users, protocols with real revenue, projects with long-term adoption potential. Not narratives, not memes, not trends. Actual usage, actual demand, actual economic activity. This layer is about exposure to innovation, exposure to new business models, exposure to emerging sectors, but with discipline. And most importantly, position sizing. No single asset in this layer should be able to ruin your portfolio. Layer 2, growth assets. This layer should never be large enough to break you. If this layer goes to zero, your life should not change, your stress should not spike, your financial future should not collapse. If it does, your portfolio is structured wrong. And here's the truth. Most people invert this framework. They put 80% in speculative assets, 15% in growth assets, 5% in foundation assets. Then they wonder why they feel stressed, emotional, and unstable. It's not because crypto is volatile, it's because their portfolio is. And volatility without structure leads to bad decisions, which leads to losses, which leads to burnout, which leads to people leaving crypto entirely. Not because crypto failed, but because their strategy did. So let me say this clearly. If you're still buying altcoins as your main strategy in 2026, you're not investing. You're entertaining yourself financially, and entertainment is expensive. Now let's address the biggest objection people have. But what if I miss the next big altcoin run? This is the emotional core of the entire debate. People aren't buying altcoins because they believe in the tech. They're buying altcoins because they're afraid of missing the next explosion. And that fear is real. Because yes, some altcoins will go up a lot. That will never stop. There will always be outliers. Always. But here's what most people don't realize. You don't need to catch every big move to build wealth. You don't even need to catch most of them. You need consistency. You need compounding. You need to avoid catastrophic losses. Missing upside is painful, but losing capital is fatal. And most people lose far more money trying to catch upside than they would have gained by simply staying positioned in strong assets. Think about this. If you had just bought Bitcoin and Ethereum and held through the crashes, through the noise, through the fear, where would you be today? Now compare that to the average altcoin trader. How many times did they rotate out of winners, hold losers too long, chase narratives, miss major moves, overtrade, underperform? Most people's actual results are far worse than their theoretical gains, and that's the gap between strategy and execution. A good strategy executed poorly is a bad strategy. A simple strategy executed consistently is a good strategy. And simplicity wins in chaotic environments. Crypto is chaos, so simplicity is power. Now let's talk about something deeper. 9. The psychological trap of being early. One of the most addictive feelings in crypto is the feeling of being early. It feels like intelligence, insight, edge, superiority. You feel like you're ahead of the crowd. You feel like you see something others don't. And sometimes you do. But here's the problem. Being early is only valuable if you're also right. Being early and wrong is worse than being late and right. Because being early means you absorb all the risk, all the volatility, all the uncertainty, all the drawdowns. And most people can't emotionally handle being early for long periods. They either sell too early, or hold too long, or lose conviction, or lose discipline. So what happens? They end up with the worst outcome. They take the risk, but don't capture the reward. And that's devastating psychologically. So they try again. They chase the next early opportunity. And the cycle continues. But here's the truth. You don't need to be early. You need to be aligned. Aligned with adoption, aligned with incentives, aligned with macro trends, aligned with long-term growth. That's how you win. Not by predicting the future, but by positioning for multiple futures. And altcoins rarely give you that. They give you one narrow bet, one narrative, one outcome. And if it fails, you fail. That's not investing. That's a coin flip with a story attached. Now let's talk about the elephant in the room. 10. The liquidity reality no one talks about. Here's something most people completely ignore: liquidity. Liquidity is what allows you to enter and exit positions efficiently. Liquidity is what allows you to sell without crashing the price. Liquidity is what protects you during market stress. And most altcoins have terrible liquidity. That means you can buy easily when things are pumping, but you can't sell easily when things are crashing. You think you're up 5x until you try to exit, and then you realize there's no real demand. Just bots, just thin order books, just air. So what happens? You become trapped in a position you can't exit without nuking the price. Trapped in a token no one wants. Trapped in a narrative that already peaked. Meanwhile, Bitcoin and Ethereum, deep liquidity, global markets, institutional participation, continuous demand. You can enter, you can exit, you can adjust. That flexibility matters more than people realize, especially during market stress, especially during crashes, especially when emotions run high. Liquidity is not exciting, it doesn't make headlines, but it saves portfolios. And most people don't understand how dangerous illiquidity is until it's too late. So if your portfolio is mostly illiquid altcoins, you're not just taking price risk, you're taking exit risk. And exit risk is the worst risk of all, because it only shows up when you need it most. Now let's zoom out even further. 11. The regulatory reality of 2026. This is another piece most retail investors ignore: regulation. Not because they're ignorant, but because they don't want to think about it. Regulation feels boring, restrictive, anti-crypto. But here's the truth: regulation is not the enemy of crypto, uncertainty is. And in 2026, regulatory clarity matters more than ever, because institutions don't operate in ambiguity. They don't invest in assets they can't legally hold. They don't deploy capital into markets without compliance frameworks. So what happens? Capital flows into assets that regulators understand, accept, and integrate. And which assets are those? Bitcoin, Ethereum, stablecoins, tokenized real-world assets. Not random altcoins, not experimental governance tokens, not high-risk DeFi protocols with unclear legal status. And this doesn't mean those assets will disappear. It means they will remain on the fringes, and the center of gravity will shift toward assets that can integrate with the existing financial system. That's not anti-crypto, that's pro-adoption. And adoption is what drives long-term value. Not hype, not speculation, not memes. So if your strategy is built on assets that exist in regulatory gray zones, you're not positioning for adoption, you're positioning for uncertainty, and uncertainty doesn't compound. Now let's talk about something even deeper. 12. Wealth is built by avoiding big losses, not by chasing big wins. This is one of the most misunderstood principles in investing. People think wealth is built by hitting home runs, but in reality, wealth is built by avoiding strikeouts, because losses hurt more than gains help. A 50% loss requires 100% gain to recover. A 70% loss requires 233% gain to recover. A 90% loss requires 900% gain to recover. Most altcoins experience these drawdowns repeatedly, which means most altcoin portfolios spend most of their time trying to recover, not grow, recover. And recovery is exhausting, emotionally, psychologically, mentally. So what happens? People burn out. They become cynical. They lose trust in the market. They lose confidence in themselves. They leave crypto not because it failed, but because they were traumatized by volatility they didn't understand. And that's tragic, because crypto isn't the problem, strategy is. So let me ask you this. Would you rather have a portfolio that occasionally 10x but frequently loses 80 to 90%? Or would you rather have a steadily compounds with manageable volatility? Most people say they want the first, but they actually need the second, because the first feels exciting, but the second builds a future. And the goal of investing isn't excitement, it's freedom. Freedom from stress, freedom from fear, freedom from financial anxiety. Altcoins rarely give you that. They give you dopamine, not stability. And dopamine is addictive, but addiction doesn't build wealth. Now let's talk about the final shift. This is where the smartest people in crypto are focused, not on tokens, on infrastructure, on payment rails, settlement layers, data availability, identity systems, privacy solutions, scalable networks, institutional integration, tokenized assets, stablecoin infrastructure. These are not flashy. They don't pump overnight. They don't trend on Twitter, but they are where real value is being built. And most of that value accrues to base layer assets, core protocols, foundational infrastructure, not short-term speculative tokens. Think about it. When the internet was being built, the biggest winners weren't random websites. They were TCP/IP, HTTP, Amazon, Google, payment processors, cloud infrastructure. Not the early chat rooms, not the dot-com experiments, not the flashy startups that came and went. Infrastructure wins, speculation fades, and crypto is following the same path. So if your portfolio is mostly speculative, you're positioned for noise, not signal, and signal is where wealth compounds. Now let's tie this all together. This is the part everyone wants, the what do I do instead? Let's be clear, this is not financial advice. This is strategic perspective, and you should always do your own research. But here's a framework that aligns with reality. Step 1. Anchor your portfolio. Make Bitcoin and Ethereum the foundation, not because they're exciting, but because they're resilient, because they benefit from adoption, because they're increasingly integrated into global finance, because they're the least likely to go to zero, because they're the most likely to still exist a decade from now. This doesn't mean all in. It means they anchor your portfolio. They give you stability. They give you exposure. They give you a base to build from. Step 2, add select growth exposure. This is where you choose infrastructure projects, platforms with real users, protocols with real revenue, solutions solving real problems. Not because they're trending, not because they're hyped, but because they're used. And you size these positions responsibly. No single position should be able to ruin you. If it goes to zero, you're disappointed, not devastated. Step 3, allocate a small speculative sandbox. This is where altcoins belong, not as your main strategy, but as your experiments. This is where you explore narratives, test ideas, learn markets, satisfy curiosity. But this is not where your future depends. If this layer performs well, great. If it doesn't, your life doesn't change. That's how you stay rational. That's how you stay disciplined. That's how you avoid emotional decision-making. That's how you avoid emotional decision-making. Now, let's talk about the mindset shift you need to make. This is the emotional core of everything. Most people come to crypto because they want to escape something. Low wages, debt, inflation, unfair systems, lack of opportunity. And that's valid. But escape through speculation is unstable. Escape through compounding is sustainable. And that's the difference. Getting rich fast feels like freedom, but it's fragile. Getting rich slowly feels boring, but it's durable. And durable freedom beats fragile wealth, every time. So ask yourself, do you want a portfolio that makes you feel smart or a portfolio that makes you financially secure? Do you want excitement or do you want peace? Because you can't optimize for both at the same time. And if you try to, you'll likely get neither. Now, let's close this out. If you're still buying altcoins in 2026 the same way you did in previous cycles, you're not playing the market. The market is playing you. Not because you're stupid, not because you're careless, but because the game has changed and you haven't. This cycle is not about catching the next meme. It's about positioning for systemic adoption. It's not about being early. It's about being aligned. It's not about excitement. It's about sustainability. And the people who win this cycle won't be the loudest. They won't be the flashiest. They won't be the ones posting screenshots. They'll be the ones quietly compounding, while everyone else is chasing. So let me ask you one last question. Are you here to gamble, or are you here to build? Because if you're here to build, then it's time to stop playing the wrong game. If this perspective helped you rethink your strategy, if it made you uncomfortable in a good way, if it forced you to question your assumptions, then you're on the right path. Subscribe for more content like this. Not hype, not noise, just clarity. Because in crypto, clarity is alpha. And in 2026, alpha doesn't come from altcoins. It comes from understanding the game and playing it differently.